Good afternoon, everybody, and welcome to the Global Market Analysis for today, June 29th, 2016, post-Brexit, with presenters myself, Jody Samuels, and Juan Maldonado. In this week's video, in this week's webinar, we do a complete Elliott Wave analysis of 5 markets: S&P, Euro, the pound, oil, and gold. We will also show how to trigger trades and get validations at market turning points. And midway through, I will turn it over to Juan, who will do the Elliott Wave analysis. Let's get started. Please read the disclaimer to yourselves. Thank you. What you see here are global markets 5-day ranges starting on Thursday at 8 o'clock until this morning at 8 o'clock. So the market breakdown with the 5-day highs, the 5-day lows, and the percentage change from high to low price, and the percentage change from open to close from June 23rd until June 29th, which is today. And in the past global markets analysis webinars, we have followed the risk-on, risk-off stories by looking at these asset classes: oil stocks, the dollar or euro as a proxy for the dollar, and gold. Hence, we have looked at the market correlations to see the intermarket analysis playing out in these 4 asset classes. This week, all markets took their cues from Brexit. It was like a play or a movie, and all markets went into risk-off mode simultaneously for 3 days before risk-on came back into the markets, which we will soon look at. But just take note of the major market volatility over here on the right and the percentage changes. Now, some of you are saying, great, what a great opportunity. Some of you may have caught some of these moves. Others probably sat out of the market and didn't want to partake in market volatility, and that's fine. Hopefully, we can give you some news today. We'll see if relative stability has come back to the markets, and which markets are stable and which markets we should continue to stay on the sidelines with. So very unusual times, historical event, massive moves. Little we're going to look at the key event driver, Brexit, which is going to continue for the next little or long while. We'll take a look at what is the U.S. impact, when will the Fed hike rates, the European impact, the UK impact. We'll touch on risk on versus risk off, and how the markets have been affected, and what is the view going forward when we turn it over to Juan to do the Elliott Wave analysis. U.S. Brexit impact. Well, the biggest question that has kept investors puzzled is figuring out when the Fed will hike rates. That has been the ongoing theme. The likely outcome has changed drastically following Brexit, as Fed funds futures are now implying only a 15.6% probability of a hike by the end of 2016. And for those who are unaware of what the Fed funds futures rate is, it's essentially used to show the market's interpretations on the probability of changes in U.S. interest rates during upcoming FOMC meetings. Pre-Brexit, Fed funds futures were pricing in a 49% chance of a rate hike this year. More astoundingly, the additional uncertainty instigated by Brexit has given a 1.2% chance of a Fed rate cut at its July FOMC meeting, while odds for a rate hike are now at near zero for July, September, and November, respectively. And as hysterical as it sounds, investors are now projecting the next Fed rate hike, some investors, by early 2018. So talk about gradual and talk about a complete change of events. To provide some perspective on the projected changes in monetary policy, Fed officials had originally anticipated 4 rate hikes this year during their meeting in December of last year. But they always noted the volatility, and at that point they looked at China, they looked at oil, and now Brexit is good. So in hindsight, is at the forefront. So in hindsight, they're probably pretty happy that they didn't raise rates yet. So from 4 rate hikes anticipated in December of last year, it was adjusted to 2 rate hikes at its last meeting in June. Following Brexit, expectations for monetary tightening has ultimately disappeared in the short term and the near term, with 10-year Treasury yields falling to levels not seen since 2012. So now let's just talk about Europe and the UK impact. Well, as you know, because you're traders, you're involved in the markets, right after Brexit, all major stock indexes in Europe got crushed. In fact, all major stock indexes across the world got crushed. But in Europe, they fell more than 7%, while UK government bonds soared, giving the expectations for loose monetary policy from the Bank of England. 10-year German bonds, Europe's safe haven, also saw massive inflows, driving yields further into negative and record territory. Central banks worldwide were prepared to intervene in the financial markets, and the Bank of England was ready to pump in £250 billion for liquidity purposes. With that said, policymakers are in fact running out of strategies to respond to financial shocks like a Brexit due to the very low level of interest rates globally. So a Brexit not only has numerous long-term effects for the UK, but it also impacts the global economy on a macro scale. And the biggest concern for the UK is that now it has to settle upon new trade agreements with countries around the world. For instance, the Comprehensive Economic Trade Agreement discussed with Canada and the EU, as well as the Transatlantic Trade Investment Partnership, a trade agreement between the US and the EU, would both exclude the UK. Another major factor which affects risk on and risk off is how long will the process take for Britain to leave the EU. You may have read about the Treaty of Lisbon signed in 2007, which is the EU member states' constitution, and it contains a small section called Article 50, which details what happens when a member leaves the group. And since it has never been invoked before, it has caused massive uncertainty and speculation because the process can take up to 2 years. So until the UK invokes Article 50, it remains part of the EU, and the market will take on a risk-on profile, or it has done. And it seems that the UK wants a new prime minister in place first before invoking Article 50. And in the last 2 days, the markets have taken on risk, as we will soon see. And we have seen consistent profit taking in all of the asset classes. So there are lots of uncertainties, lots of risk remaining in the markets, but we have to keep following Brexit because that's going to be the driving force over the next many months. And of course, interest rate moves and this risk on versus risk off theme. So now let's look at some markets. This is the correlations between all the asset classes that we've discussed. And let's just look at the right side over here. This is the daily, and we can see that all of the markets sold off, and then they came back. So risk off followed by risk on. Now let's specifically look at the currencies first. the euro and the pound. First, the euro, and all we're going to do is we're going to highlight the moves and what has happened subsequent, and then turn it over to see our Elliott Wave analysis on these markets. So this is the Brexit, and then subsequent to that, we had some profit taking and continuous sideways movement. So the market didn't make a new low in the euro. The market, in fact, traded sideways and did not take out this low. Having said that, let's look at the pound. The market continued to sell off after the initial sell-off. So it rallied, it retraced, and then it made a new low. Okay? So the pound is much more uncertain in terms of what the effects will be to price. I mean, we haven't seen these levels since I guess the 1980s, when I was trading the British pound for a major U.S. investment bank, in fact. So the euro doesn't make a new low, the pound makes a new low, but same theme. Post-Brexit, the market sells off for 3 days and recovers in the last 2 days. And I know that some market participants have tried to pick bottoms in the pound. Have they picked a bottom here or here? Well, they would have seen a new price low. And subsequent to this second price low, we have seen some sort of a rebound. However, given the uncertainty in the market, I wouldn't be long the pound for too long. Okay? In fact, I would look to really continue to sell the pound on rallies, at least until the market settles down. But probably not taking a position in the pound is the best trade of all, because there's so many other opportunities in the currencies that are trading very, very well without this market volatility. So really what I'm saying is, don't try to pick a bottom in the pound, because we just don't know. We can't anticipate what will happen. But some of the other currencies, if you're trading currencies, the Aussie, the Kiwi, the Canada, those are moving pretty nicely, and you might want to look at those against the yen also, because there's been some activity in the dollar yen and some talk from the Bank of Japan, some intervention, etc. So those might be good markets to focus on, but that's not a subject for today. Now let's look at oil and the S&P. Oh, this is oil. Where's the S&P? Okay, why don't we look at the S&P? Well, here, let's just go back to oil quickly. Oil traded to a low of 45.84, so that was a pretty massive move down, also down to these levels, only to recover in 2 days to that magic $50 level again. We can't see it on the screen, but this chart was taken at 8 o'clock this morning. It did trade up to and retested the $50 level before giving back some gains, just before. And the S&P traded down to 1991 post-Brexit, and it has regained about 61%, 8.8% of its losses. So just moving back up to oil, well, looking at oil and looking at the S&P, you can see the magenta line on the S&P. They have tracked each other. And just as we made a new low in the pound, we made a new low in oil, we made a new low in the S&P. So the S&P and oil made new lows, subsequent lows, and have since rebounded at least 61.8% of the entire move down. So this is not a one-way street. Absolutely, it's not a one-way street. And this just shows us, with this major move off the lows, what the market's inclination is, and how they just they're quite flexible to take on risk whenever there's a chance to take on risk, and shed risk when they need to, just to test the waters, and then take it on when they feel that the market has a chance of coming back and being more stable. Finally, gold with the euro overlay. Gold post-Brexit moved to safe haven status and broke the typical inverse correlation to the dollar. So the typical correlation is gold goes up, the dollar goes down. But if we zoom in right over here, what happened, using the euro as a proxy for the dollar, gold went up and the dollar went up. When this orange euro goes down, it means the dollar goes up. So it broke the typical inverse relationship because of the safe haven status that the market assigned gold during this time of market crisis. So will the inverse relationship come back to normal? Well, I suppose in a risk-on environment, it will. In a safe haven risk-off environment, it won't. Bottom line, relative stability has returned, and in quotes, to the markets, but perhaps the asset class most affected has been interest rates and interest rate expectations by market participants. So stay tuned for additional Brexit news. Be on the lookout for additional Brexit news to drive markets in the coming weeks. So now I'm going to turn it over to Juan, and if you like Juan's analysis on Elliott Wave analysis on these markets, just so you know, we have an ElliottWaveDesk.com service where Juan produces these video analysis every single day. So ElliottWaveDesk.com if you're interested in pursuing this further. I'm going to turn it over to Juan now, and thank you very much.
Thank you, Jody. That was fantastic. And hello, traders. Welcome, and thank you for being here with us today. My name is Juan Maldonado, and I'm going to explain the wave count, our wave count on the EURUSD, the pound, the S&P, oil, and gold. The idea with Elliott Wave is to find the direction of the market by validating each of the waves. I'm going to explain the wave count, and we're going to make a top-down approach on the euro in order to get to lower time frames and find some Elliott Wave setups inside. When you are analyzing a market, it's important to check the higher time frames, even if you are a scalper, a day trader, swing trader, because the higher time frames are going to tell you the trend. Then on lower time frames, you can find internal trends, but with the higher time frame analysis, everything makes more sense. The weekly chart on the EURUSD is facing a consolidation since the last low on March 8. Let me highlight better the low. Right here was the last low that the euro did on the weekly chart. After that, a strong drop since the 147 area. So it was a quick drop. When the market is trending, it's easier to trade, because mainly what you need to do is to find a trend following strategy to find the retracements and get in the trend. But once the trend is over, it starts consolidating, being sideways or corrected. And of course, it's going to be more complex. because you need to navigate inside those complex waves, but thanks to the Elliott Wave theory, we have that guidance and can be easier to find setups inside. Our plan is that the EURUSD did a leg down, and the price is currently building a triangle continuation. The triangle continuation, we're calling this the B wave green. So something important from the wave theory is that between one wave and the other, we are going to find waves inside, because the markets are fractal. The main idea with the wave theory, when we are counting the waves, is to find the higher time frame wave and then go to the lower time frames and start finding the inside or internal waves. So what we're saying is that between A green and B green, the EURUSD is making a triangle, symmetrical triangle. So we have the move up for wave A, a move down for the B wave, a move up for the C wave, and now the price is building. Currently is the active wave, the D wave, then we expect the E wave. Once the triangle is complete, and in Elliott Wave theory, the triangles are 5 waves at least. So once and usually it's a 5-wave sequence, but once the B wave is complete, we're going to look to find the breakout of the triangle, of the consolidation. Definition of a breakout: a candle close below the triangle line. And if the price starts adding momentum, we can activate lower targets. Not yet. So we don't want to tell you that the price is going to the 0.90 or the 0.85. We're not saying that. What we're saying is that we're focusing in the correction. And once we have the technical evidence that the corrective is over and that the continuation is breaking to the downside, we can start activating bearish targets. That target will be, in that case, if only if the technical analysis confirms. That's gonna take a while, maybe the whole year, we don't know. For now, we're in the corrective. But the target, we can start thinking of the 61.8% Fibonacci extension of the previous wave A that comes to the 0.9294. That could be our target, long-term target in the weekly, but for now, the medium-term target is inside the triangle. So inside the triangle, we have conservative targets at the 107, 108 area. That's the weekly analysis. What about the daily? From the daily chart perspective, now that we understand the weekly, it's going to be easier to understand the waves inside, even if we see some complex wave counts. Don't worry about it. Actually, it's pretty simple. So the daily chart, on the daily chart, we are forecasting a 3-wave sequence where the first leg is over, complete, the leg down, W, then a connector wave X, and then a connector wave Y. If you want to make your own wave counts and keep it simple, you can just label A, B, and C, and it's the same, a 3-wave sequence. So don't get confused because I'm using WXY, it's just because I am taking care of all the details inside of the wave theory, and that's why I'm using the WXY. But if you want to make it keep it simple, just use an ABC, it's the same. What it means is a 3-wave sequence, because the triangle waves always are going to have 3 waves inside. And one of the waves can be more complex. But we're in the D wave. Our target or destination is the previous low area. As I said, the 108 area will be this destination. So I think it's clear, the forecast on the daily. Let's continue going down to the 4-hour chart. We can start talking a little bit about the reaction, the market reaction after the Brexit. After the Brexit, the price did a double top. Well, before the Brexit, it did a double top 114.18, a lot of volatility. Even if you see these huge moves that we can say, oh, I wish I could trade that move and make a lot of money. Actually, it's pretty complex because after the fact, you're seeing those big red candles. But during the news, during those huge fundamentals, the volatility also is impressive. And the price is going down and going up and going down and going up pretty quick, and it's extremely, extremely risky to trade and extremely difficult. But now that we are post-Brexit, after the Brexit, we can start planning our next move by using the Elliott Wave theory. In the technical analysis, when we have a strong move, we're looking for a continuation. So that's something simple. In technical analysis, if you have a move down, and then the price starts consolidating in any shape, you're expecting another move down, at least 3 waves. It's rare to see a reversal after a strong move down that adds a lot of momentum to the market and then just a new move up. This is not common. Anyway, as traders, we have to be ready for everything. But our main wave count says that after the Brexit, volatility and everything, we are seeing a 5-wave sequence down, 5 waves, that is compressing in technical analysis. This is known as a wedge formation. In Elliott Wave, we call these structures diagonal waves, in this case, leading diagonal wave. And after the wave 1 comes the wave 2, 3 waves. Pretty simple, the wave count in the hourly chart. 5 waves down and 3 waves against the 5. Then our mission now as traders is to find the end of 2, because everything I have been talking about is analysis, but now we need to find validations. The validation that we can use is a trend line. If you want to learn a fantastic trading system, that is the wavy tunnel, that you can learn the wavy tunnel with us. It's a great trading system that will tell you precisely where to validate the end of the waves and where to place the stop entries, exits, everything is fantastic. Anyway, just with a simple trend line, we can see where the wave 2 can end, and the breakout of that trend line will tell us the end of the wave 2. So actually it's pretty objective, the validation, because only when we have the breakout of the trend line on the hourly chart, we will have the end of 2. This is the bearish scenario. Another scenario could happen, an alternative scenario, always when you are analyzing the markets, is good to have another view in case that the move down doesn't validate. The invalidation of the bearish one is a 111.90. So the price, if for some reason, let's add our trend line again, starts makes a continuation to the upside and makes the invalidation, well, you never have a bad trade. It's just a change of wave count in that case, because you didn't have a bad trade or a bad decision if you wait for the validation. That is key, to validate the waves in order to be successful with this technique. So that's the plan with the euro. Let's continue watching the price action during this week. Validation will tell that the wave count is right. Invalidation, that a different wave count is happening. So we adjust and start looking for that wave count. That's the plan for the euro. Now let's review the pound. Jody did a fantastic explanation about the price on the pound. And it's pretty complex to analyze the pound. On the 4-hour chart, actually before everything happened, before the Brexit, we were looking to find a move down and then the reversal. So the question is the question that we need to find the solution for, the answer for, is if this whole move down was like a real move or was a fake move. Because according to technical analysis, it's better to wait for retracements and continuations. So I will say that in terms of Elliott Wave, we can create a simple validation, bullish or bearish strategy. This is analysis. Be careful with the pound. Currently, what the market is doing is a corrective wave. It's clear that inside, clearly the market is doing just a three-wave sequence, 3 waves. We can't count those waves in another way. But the plan would be that if the price makes here a retracement, fails to break out the channel to the downside and then makes a strong move up, that will be a wave 3. And that will change the bearish sentiment to a bullish scenario. That will be a wave 3, the strongest leg. But before taking any decision, we need to see that. Currently, we do not have any wave 3 in this corrective. So that would be bullish scenario. And a bearish scenario would be the breakout of the channel to the downside. But be careful with the pound, because it's not safe until we have a structure, 5-wave sequence or something, but this price is just a sideways job. Good. What about the S&P? For the S&P, let me clear this wrong here. Let's take a look on the weekly chart, just with price action, no Elliott Wave, no nothing else, just pure price action. The S&P has been doing a consolidation since the top of the market. That was around May 2015. The price started a consolidation. It's not the end of the bullish market. We think it's just a pause on the weekly chart in order to continue to the upside. But the question is when, and when that corrective wave is likely to be over. According to our studies using the Elliott Wave theory, we have been studying bar by bar. We came with the idea that this corrective wave isn't over yet. Then the price is likely to continue down just inside the channel. As always, we need to validate, and I will show that in a second on lower time frames. So in lower time frames, I will check in a second the validation. So it's not the end of the world, it's not the end of the bullish market, it's just a pause that always happens in any market. And after that leg down, then the stock market, according to our studies, will continue up. The key to validate that will be to see a 5-wave sequence. Then we will know that the market is over. But we have been studying this move up by bar, and we came with the idea that this is just a leg of the corrective wave. It's not the end. So that's why we think the S&P is likely to go down and has been rejecting the upper continuation line. Now that we understand that and that we are validating the top of the market, after the Brexit, the S&P did an expanded setup. As you can see, it's expanding. It's complex, right? Difficult to trade on any time frame. Anyway, we're looking to see the reversal after this move up with a strong wave 3. When we are trading by using Elliott Wave, always we are looking to be part of the wave 3, because the wave 3, if you don't know, is the strongest wave. It's the best wave because it's going to give you a lot of points, but also is the most difficult one to find before it happens, especially at the beginning. Because, for example, here, the price is bullish. So nobody can try to short, to sell when the market is going up. Doesn't have any sense. So the plan, because the Brexit just happened, is to start seeing the reversal. We can use the 1 to 3 reversal for any short validation. And once the wave 3 starts, it's kind of easy to follow the wave 3 because the retracements are small. compared to the trend. So we can start following the trend once it starts, and that is better than trying to pick the top of the market. It's better to have validations and go with the trend. So we are in that cycle, in that market cycle. Our wavy tunnel system is saying that the price might be close to find the top of the market. We are having here a kind of a double top. That's the plan, to see the reversal at those levels. And then we start following the trend. For now, lower time frames, market is bullish. We don't have any reversal yet. So mainly that's the plan with the S&P. And what about gold? I think gold is the next one. Okay, so for gold, after the Brexit, the price did a pretty strong move up, but was huge. But for gold, we consider that the move up is better than the others, like in the S&P, like in the pound, because the price is added momentum to the trend. One of the indicators that we use, the oscillator, to show the strength of the market, and that's powerful. That's pretty powerful, the bullish move. So I present a daily video in our service, and this morning I was talking about a setup on gold that I really like, because look, if we add a trend line on the upper side and we do the same on the lower side, there is a triangle. The price is building a triangle. A, B, C, D, and this could be an E wave. The triangle is a powerful continuation pattern. If we look to the left, all the momentum is bullish. Then, at the breakout of the triangle, the continuation is bullish. So the plan for gold is to follow the price inside of the triangle according to Elliott Wave. This is A, B, the C, the D wave, and the E wave. So those are the waves that we should follow during this week. If we have reactions, if we have a strategy like the wavy tunnel that can help us to find our validations at the end of E or lower time frames, then that trade could be fantastic. But it's important to see the market reaction at the lower side of the triangle. Something that we don't want to see is a breakout of, to the downside of the triangle line. That will be bad for this pattern. And oil, I really like oil. It's complex, the price action, but I like it because the price has been moving up and moving up. But it seems that it found the top of the market because, look, the price on the left was making new highs, move up, move up, move up, move up, and watch all the retraces. All the retraces were higher than the previous retrace. We didn't have anything. But this move down did a strong move down, and it took out all those retraces on the left. So that was the first warning in terms of price action that something was happening because the market started changing. And then it did a move up. And this move up is important because it couldn't make a new high. The high was right here. And that was a nice evidence that the market can start changing from bullish to bearish. According to the classical technical analysis, a nice confirmation will be a 1 to 3 reversal. That will be the breakout of this low. Didn't happen yet. So that breakout is important in order to find the continuation. But if we wait for that confirmation, we're going to lose all these move down. And we want to be part of the entire move, or at least more points than waiting for that confirmation. That is why we have the multiple time frame. Let's go to the hourly chart. On the hourly chart, the price did a nice 5-wave sequence that I think is pretty clear. 1, 2, 3, 4, and 5. So that 5-wave sequence ended and the price started to move to the other side in a 3-wave sequence. The Fibonacci retrace for the wave 2 is the 88.6, and the first leg was the 38.2. In our Elliott Wave Ultimate course, where we teach the harmonic patterns, we call this pattern a bat pattern. But just with the pattern isn't enough to take a decision. It's just analysis, but it's powerful analysis. And this move up is pretty strong. So then the validation for 2, we can use the trend line. So the breakout of the trend line will be one validation. But also it's important to find a 1 to 3 reversal. Because don't forget that the 1 to 3 reversal is the change from bullish to bearish. It's the first signal of any change. And of course, with the breakout of the trend line, we have the confirmation. So let's wait for those validations before taking any decision. And let's keep an eye at the invalidation price on the hourly chart that is at the 50.54, where the previous wave 2 ended and the wave 1 red started. So that's the plan with the Elliott Wave theory. Have a wave count, but validate your wave count. Just with the wave count isn't enough. So be careful with that. So that was the analysis for this session. Thank you very much for your time. Now, Jody will continue with the webinar.
Thank you, Juan. I'm sure you all got some clarity on what we're expecting to happen in the markets from a fundamental and a technical Elliott Wave analysis standpoint. I'm just, okay. Whoops. Good. And I want to thank Juan for his terrific analysis. As usual, you can now see the screen. I want to thank all of you for being here. I know that everybody's very busy these days, and we're moving into a long weekend. So thank you for being here. And just a note, for daily market analysis like this, please check out ElliottWaveDesk.com. So we hope you got a lot out of this fundamental and technical analysis, and we hope to see you again next month in our monthly market analysis series. Thank you very much. Bye, everyone.